Good afternoon, sir. Welcome to Amma with Thinkly. It's a pleasure having you with us today. For the audience, Mr. Tamal Bandyopadhyay is a respected business journalist from India. He's been writing Bankers Trust column for a decade now, sir.
No. More than that.
More
One and
than
a half
that, right?
decade. Yeah.
Wow, 1.5 decades, right? He has also written 6 books, right?
Seven.
And 7 books, great. Okay, in fact, one book got translated into Bengali as well.
Yes.
Right. So you have to tell us how you started. You are a postgraduate in English literature, and now you are a keen observer of Indian banking system. So how has the transition been?
No, there's no transition as such. When I got out of university in mid-80s, almost 40 years back, 37 years back, 38 years back, there is nothing else one can do. I mean, there are not much opportunities in West Bengal. Either you teach in college or school or university, whatever, depending on your qualification, or you go for civil service. So in my family, I had both. So I thought, why not try something else? Or you go into, there were other options like study law, etc. But I thought, why not try to do something else? And I came across an advertisement by Times of India looking for a trainee journalist, and happened to be that was the last batch. Then by the time Times of India also started a college for journalism in Delhi, so the first batch from the college and the last batch picked up from different zones through very intense exam, both written and verbal interactions, etc. So it almost coincided. So I landed in Mumbai, absolutely no idea what journalism was. I mistook it for a creative writing, and when I saw the journalist in the big hall, I found they're all typewriters. I thought much. So it was a struggle, but I had nothing to do again on business and finance, etc. I was a part of then Sunday Review magazine run by Fatma Zakaria, a very kind, affectionate lady, and I got into the group very fast because the team was great. And I was just hardworking person and doing everything like reviewing books and writing features, nothing. And then to cut a long story short, I had to go back to Kolkata after a few years because my father had a very severe accident. And in Kolkata, Times of India could not accommodate me. I got into Economic Times desk. That was my introduction to business journalism. And those are the days in West Bengal, coal and jute. Heavy industry was dying. Economic liberalization came, but it went over my head. I had no idea what, because I was in the desk. But I was writing continuously in various forums, like first in business, first in the evening news, of course, Times of India, and as well as a new paper which Times of India brought out, and Illustrated Weekly, again non-finance. And then from there, I shifted to Business Standard again for writing, nothing to do with finance, the feature writer. And when Business Standard started its edition, it was a one edition, Kolkata edition paper. It started in Delhi and Mumbai. They checked whether I would like to come back. I grabbed that opportunity and came back. And I was told that I have to cover banking. I had no idea what banking, but that's how I got in there and on the job. And you can say I fell in love with it. Before doing banking, I used to think that banks deposits are their assets and loans are liabilities, because I don't have any banker in my family and I have no idea how to read balance sheet, nothing. But as I said, you can say that I fell in love with it, and I started seeing through the window at banking the entire world, the macro picture and the connectivity, among the foreign exchange market and the bond market and the deposit rates and the loan rates and the inflation, growth. So all these things, not in isolation, but I tried to see it that oh wow, it's fascinating. It's just a movie unfolding, or OTT series unfolding in front of you. I loved it. And of course, because I didn't have the required kind of background, no study in finance and economics, I had the, what do you call it, I was brave enough to ask a lot of stupid questions or all the forum, and people used to laugh about it, many of that time. But I used to get great answers, and I many of my understanding, much of my understanding, and many of my stories came out of these stupid questions, which I continue to do even now.
That's a very, very inspiring tale, sir. As Steve Jobs would say, you always correct the dogs, but only from the back. Right. So banking system 4 decades ago, 3.5, 4 decades ago, and banking system today. So one major difference has been private sector banks. So what is the role private sector banks have played in the last 3 decades? Now that you've been, part of the entire journey.
Yeah, I mean, I joined the profession, joined this particular segment as a banking reporter just after the couple of years, or less than couple of years after the birth of the private sector bank. Now, what they have brought in, they have actually changed the entire banking system. I mean, and you have to see that public sectors is not just giving up; they are also changing. So that's the most important thing. It's you just look at what happened in the insurance segment vis-a-vis LIC. Of course, insurance segment opened up later. The new private banks came in 1994. Insurance segment came in this decade, early this decade, the beginning of the decade. But LIC, see how the LIC has changed, both in terms of marketing and the spread and products, everything. Very similar thing happened in the banking segment. Earlier, the public sector bankers were a bit sleepy, and you would say that it was a sort of, it was a seller's market, not a buyer's market. I had my experience in Kolkata when I was working there. It was, I don't want to get into all this detail, but it was really difficult to open an account. I mean, I could not. I tried at all 3 banks in Kolkata to open my account. I could not get to. It was predominantly, among other things, technology was not there. And of course, the trade union ruled the show. So the entire mentality and the branch manager within this, glass wall was sort of the jamindar or the king within a branch. That was the kind of thing. And from there, you see that you and I are being wooed every day for loans, for deposits, for credit card, for many other products. So the entire seller's market has turned into a buyer's market. That's a great thing. Of course, technology, first public sector bank, private bank started, and then public sector bank also joined, and then technology has changed everything. In India, what is doing in the UPI, which is the payment system, it's something remarkable. We are much ahead of all the developed markets. I mean, you go out and you buy something for worth 20 rupees or 30 rupees, even that you can we can do through UPI. So in the payment space, there's a remarkable change. The entire technology thing, we don't need to go to bank. It's in our pocket. The mobile phone itself it's a bank, and then the tremendous work on the financial inclusion front. What the 90s, the microfinance were doing, and even then after that also the NBFC, MFIs, as well as the various trusts and non-for-profit. Now the banks are into full-fledged into there. Earlier, even now banks have been doing through the BC model, that is the business correspondent model, but on their own also they are doing. It's not exactly, it's not a charity work. It's a spread also makes, adds to the bank's health. I mean, where else do you get this kind of spread, the interest rate? Because you and I are very stingy. You are in urban thing. We find out how much is there, how much is my interest rate, what is my outgo, etc. But in rural areas, in remote villages, etc., they don't care about interest rate. They see that how much I can pay, what's the EMI, and it's the moneylender versus the banker. So if moneylenders can charge 40-60% and get away, bankers can charge, and they are charging 20% plus. Many of them are charging, but at the end of the day, we are seeing more and more people coming under the fold of bankers. And of course, government PMJDY, Prime Minister's that's Yojana scheme has played a great role. The way the financial inclusion happened in India, it's a remarkable story. But still, there are many there are pockets. Even in urban India, which you speak about, both of us, we are in Mumbai. But for our drivers, our maids and our cooks and our dog workers and other support system, it's not easy to get into banking. So there is much more work needs to be done. But overall, Indian banking has come a long way, and public sector banks have changed. And you ask about particularly public sector bank, you see the profile and the number of public sector banks also have changed. Like, for instance, State Bank of India had so many subsidiaries, associate banks. Now State Bank of India is one, and that by virtue of that, State Bank of India has become one of the 50 largest banks in the world. And State Bank of India has is doing remarkably well on the technology front. And then all the other banks, have you seen that there are multiple banks which have now been consolidated in 2017-18? They all got consolidated. A bank like, say, UBI and Allahabad Bank is no more there. And so are many other banks. So we have lesser number of banks. The duplication of business has gone down. And I think the banks, the cleanup, what happened under RBI governor in between 2013 and 16, and the next governor also, Rajan started it, and then his successor also followed it up, the cleaning up of the balance sheet of the banks. And that's particularly the public sector banks were affected by that, the NPA problem. So it was like some of the banks, you see that IOB, which is it's now doing better, or for that matter, IDBI, almost 1/3 of their assets were bad. And then Reserve Bank of India came with an iron hand and did this, the so-called asset quality review. It's the first of its kind in the world. What does it mean? What was asset quality review? RBI was not happy with what the banks were saying or the auditors were saying. RBI did send their own people to the kitchen of the banks to find out what is there hidden. And that's how the bank was actually stripped naked. I mean, they had no place to hide. Around the same time, we also found that very aggressive investigative agency like CBI, bankers were put in jail, etc. It's quite unfortunate that our investigative agencies' ability in the financial sector issues are not that great. So I don't know how many cases have actually been, the charge sheet have been filed and the cases have been taken to logical conclusion. But the bankers, I would say overall the bankers were harassed. But at the same time, their balance sheets were clean, etc. So that was a phase we have undergone a remarkable change. And as we speak, post-COVID, things are pretty good. Banks are doing well. If you look at the stock market, you see how the public sector bank you are talking about, how they have been, how their stocks are doing. I mean, you look at any bank, whether it's Indian bank in Chennai or UCO Bank in Kolkata, you see their stock market price and how they are going up. So it's a remarkable story. Having said that, if you look at the numbers, the share of public sector bank is going down. In fact, there are various people have been talking about various numbers, how they are losing their market share. They are fighting it out, I must say that. If you see from 80s and 90s and now, I think from their market shares where it's the 90% or the 90s and all, and after that it came down, and now it's probably just about 60% plus. But that's on the outstanding basis. On an incremental basis, you will find their stocks for every 100 rupee, their share for every 100 rupee worth of deposits as well as every 100 rupee worth of loans are coming down much less. It's much less than 60. A few years back, it was in their teens. I don't have the latest number. So yes, their market share is coming down, but to their credit, public sector banks are also changing and they are not just giving it up.
So the adoption of technology, sir, has been equal in both sectors, public and private sector?
Certainly not. I think public sector bank, in a comparative thing, they are not doing as well on technology at some of the private banks. Again, if you look at the private sector banks, not every private bank is technically tech on the tech front. They're doing great. I would not like to name any particular bank, but most of the large private banks are doing pretty well in terms of technology, whether it's account opening or the time taken to assess you and me and sanction our loan and disburse our loan. If you look at that, public sector banks still not there. I mean, there are 1 or 2, 3 large banks who I would say, again, I'm not naming, they have done better than others. But overall, the challenge is still there. If you see in terms of account opening or in terms of like one particular bank through video, I mean, the video call, the account can be opened. You talk on the video and everything is captured and then the account is open. Not only one bank, I think more than a few banks are doing in private sector. Now in public sector, they have definitely changed. They are doing much better than what it was. But in terms of taking time for assessing, for opening an account or assessing a loan request and sanctioning that and disbursing the money, the time taken between your application and you getting money, etc. If you all these parameters, if you see, public sector banks still have to do much more. That's an issue they need to do. But overall, what they were and what they are now, certainly much better.
So this is actually kind of a quandary. On the one hand, private sector banks are doing much better, as you put it, on an incremental basis. Their adoption of technology is far better than public sector banks. But just looking at a couple of numbers, the PSU banks have far outpaced public sector, private sector banks in their share prices. What could be the reason for that? And last month alone, PSU banks have rallied 20% last month alone. And if you look at it from the pandemic lows, they have doubled. In fact, public sector banks have done something like 400%, given 400% return, while private sector banks are doing less than 200% return. Absolutely. Why such a large disparity?
Yes, absolutely, because as I earlier, before you even said, I said how the stock market is doing. So yeah. The main reason is this, the pricing part. If you see, I'm not getting into all the technicalities, but if you look at the price to book, etc., they were much, much undervalued compared with private banks. If you look at the private banks, now, again, I don't like to name any private banks. There would be a few private banks which could match public sector banks, very few of them, but many of them are not. Most of them are not. The main issue is this, as I said, because of the cleanup exercise. So the private banks was relatively, when it comes to corporate loans, etc., those private banks which have huge exposure to the corporate India, like let's name it public, ICICI Bank and Axis Bank, their level of NPA in that particular segment was almost like a public sector bank. Overall, it was much less. But when the others like HDFC and Kotak, etc., whose exposure to corporate India was much less, they are of course much less. Even these two banks which I named, their corporate loans turned bad as much as like private public sector banks. But overall, their NPAs were pretty low compared with public sector banks. So public sector, the expectation from public sector banks was just nothing at that point of time when this AQR started happening and they started losing their value like anything. And from there, it's a remarkable turnaround for the public sector banks. banks. And again, I said that if you see, look at the metrics, which is price to book, they were where private banks were almost fully priced in and all, you will find that 3 times or 4 times price to book many of the banks, which is high by even by global standards. I mean, where else do you see a bank as 4.5 times price to book? Some of our private banks have been doing that. So how do you expect them to go even more? So they are just continuing with their growth story, and accordingly the stock market is the stocks are priced. But public sector bank, they were underperforming terribly at that point of time. Most of the banks were some price to book, if you see, maybe 40 basis point, 50 basis point, 60 basis point, that kind of thing and all. And they have done remarkably well. They have cleaned their book and all. So the market is rewarded them pretty well. So that's the main story. The value of private banks already were there, and market was rewarding them. But public sector banks were laggards. But now market is getting aware of their value, and market is rushing and buying them up. Now, one of the reasons, it's the thing, but sometimes you feel like whether the irrational exuberance and what else, how long it will run. And also there is a little sub story, as you are aware of it, that government of India, Prime Minister a few years back in the budget speech spoke about privatization of particularly 2 banks, but which 2 banks the speculation is on. So that there is a parallel story is this. Here are the banks which have there is solid network in terms of branches and kind of customers, etc. And they will privatize, they will change, etc., etc. So and then speculation keeps on changing that which is this bank. Now, when is it going to happen? We don't know. I don't want to believe that this is going to happen very soon, because even IDBI bank privatization has not yet happened, and elections around the corner, so it's not going to happen. But market has its own logic. So they're doing well, and the underlying thing of privatization, and they were underpriced heavily. So all this is contributing to the fact that they are doing, in a relative sense, public sector banks in stock market doing better than the private banks.
Right. So is this because of the bad loan write-off?
No, bad loan. It's bad loans. How they have done it. It's there. Very often you will find a story of X amount has been written off, and there is some parliamentary question, and then the media will say that how is it possible? How do you do? It's your money, our money, etc., etc. So how do you do this? How do you clean up a book? But there is many ways of cleaning up a book. One of the thing is written off. Second thing is, of course, recovery, and third thing is selling it off to AFCs. So if you see that both public and private, they are all doing all the three. I don't have the numbers on my table in percentage term. In percentage term, how much is this and how much is that? But recovery also is contributing to the profitability. Some of the banks, like for instance, often I remember UCO Bank, if you look at their profit last year, I'm talking about, not this year. The operating profit was not that much, but net profit was pretty healthy. One of the contributing, if not the contributing factor, was recovery. So recovery also they're taking care of recovery. Then of course they are selling it to ARCs, and of course write-off. And the concept of write-off in India is unique than elsewhere in the world, because here it happens, if you write it off, it goes out of your balance sheet, but those particular loans are parked in certain branches. And as and when you recover, it directly adds to your profitability. And what happened is this: you dare to write off, or you write off because you have already provided for. If you look at the Indian banks, I'm talking about irrespective of the classification, whether it is private, old, new, or this thing. I would like to believe the average provision coverage ratio is 70% plus. Like some of the banks are 90%, 95%. What does this mean? A loan has gone bad, 100 rupees, you have 95% you have already provided for. So then this particular loan is parked somewhere else, and if you are selling it off at 30 or 34, 30 or 40 rupees and with some kind of upside, so you are in the money because you have already provided for 90% or 90 rupees. Similarly, as and when you are actually recovering the written off thing, that also adds, as I said, anything you are recovering more than 30 or 40. I mean, anything you are recovering, it's straight away adding to your profitability because you have already provided for that 90% or 70% or 80% you have provided for that. So it's yes, write-off is one of the contributing factors. But I think at times we don't appreciate the nuances of the entire thing.
Right. So has the business cycle started, as the credit cycle started contributing to the euphoria?
Yeah, of course. If you see so bankers were, if you look at the numbers, balance sheet numbers, the credit growth and deposit growth, etc., you would see that pre-COVID, the credit growth was pretty low. I mean, there were, I think, a few years it was in single digit. Now, primarily, bankers were, there was a kind of, one, of course, demand was not there because economy was not doing that well. I don't want to burden you with numbers, but the fact that that's a fact. There are multiple issues were there. And then another contributing factor was the bankers were suffering from a fear psychosis because bankers were arrested from their house, picked up from their house, and bankers were thrown into jail. So all these things were happening. There is a terrible fear psychosis. So bankers said, look, if I don't give loan, nobody bothers. Nobody would hound me. But if I give loan and it turns bad, then things are going bad. I mean, it will ruin my life, my family's life, etc. Rather, I will not do anything. That was the kind of situation at that point of time. I'm talking about 2017, 18, 19, 20. Those are the 3-4 years. If you see, the credit growth was less, single digit, demand was less, and the banks' most banks' willingness, I'm talking about particularly public sector banks, because of the over-aggressive investigative agency, they lost their appetite to build up balance sheets because they knew that no work does not punish them, but some work and something gone bad, even for justified commercial decision, it can go wrong for multiple purposes, for external things, for export market collapse, for that particular product, or so on and so forth. You will be punished. So all this combination led to this. But then post-COVID, there is a tremendous enthusiasm. From the borrower's perspective, things started going. We have done much better than rest of the world. You know that we are a fastest growing economy. That's the part one, particularly in the personal segment, retail loan, etc., going very high. And of course, the fear psychosis the banks were suffering from. I think finance ministry went out of its way, and there were meetings where the investigative agencies' bosses were there, and bankers are told that you take decisions without fear and favor. We will not harm. Banks are doing well, and of course there are issues like credit growth is higher than deposit growth, so both in absolute term as well as in percentage term. So that story is more than 1 year old now. It's about 2 years now. Credit growth, deposit growth is lagging, which is why the main center now of all banks' attention is how to gather deposit. There's a war is going on. Those are the different stories, but certainly the credit growth is adding to the bank's net interest income, and that is adding to their profitability, and which we have seen the profitability. If you see the last 5 quarters, every quarter it's going up. I've heard Mr. KV Kamath saying at some point, probably 6 months back or even more than that, that he has never seen so good bank system with such a great health in the past 50 years. So that's the story now.
Right, sir. But we are now in a situation where interest rates have gone up substantially over the last couple of quarters, though of course they've been stable the last 2 or 3 cycles. So what is the impact this is going to have on credit growth?
Well, you rightly said that we have seen our interest rate going up. I mean, the repo rate, which is the policy rate, is going from 4% to 6.5%. That's between May last year and February this year. And since then, we are holding on an operation at 6.5%. And RBI stance is it's essentially there should not be allowed any withdrawal of liquidity. That's the kind of stance. So it's a reasonably hawkish policy last year. Last policy in August, and as we speak, we are just a few days away. Tomorrow is the policy starting. Let's not guess what's happening there, but the fact is this: yes, the interest rate has gone up and it's stabilized. So there now, is it the terminal rate and there it end, and when the interest rate will start going down? That's a separate story. This is not the forum to discuss. We're talking about how is it going to affect banks' credit growth and banks' health. Now, if you see, there is not much of impact on credit growth as such at this point of time, because if you genuinely need money, I mean, that's everybody says that a few percentage point here and there, whether it's 25 bips or 50 bips or even 1%, the cost is not really important if you really have a project to go for. But so we have not seen any visible impact on credit growth as such. But what could happen, and I would say that probably there is some signs of there, the bank's quality of assets. So like, as I said, the banks came up absolutely clean, and this balance sheet is something fabulous. I think the in percentage came from net NPA and gross, etc. It's more than a decade. We have not seen this kind of health of the banks. Now, what is happening? Suppose, particularly in the retail segment, I'm told in some there are cases where, say, interest rates have gone up, maybe almost doubled or 1/3 or more than that, say like a home loan, etc. If you have got the lowest loan rate cycle, and since then where you have come up, it's pretty 30-40% you are paying. So many of them are just paying the interest and not the principal at all. And there are certain cases where the things are going not going exactly the way it should go. So there is a technically, what you call it, before one account turns NPA, it turns NPA only if you and me are not able to pay for 90 days plus. But before that, there is stages called SMA1, SMA2, SMA3, etc. That is special mention account 1, special mention account 2, special mention account 3, etc. Like if we can't pay for 30 days, my account becomes SMA1. If I don't pay for 60 days, then SMA2, and then more than that, SMA3, and then become NPA. So my understanding is this: many banks are seeing that loans which are clean, absolutely good, now getting into that category of SMA1 and SMA2 in the past few quarters. So at some point there is a hope that Reserve Bank of India will reverse the cycle. Maybe earlier it was thought probably in December, and then it was thought probably in February. But now, as we speak, it will take longer because the uncertainty of inflation is not exactly under control, even though it's food driven, but it's beyond Reserve Bank of India's target inflation. And then, of course, globally, we are seeing what's happening in the commodity cycle, and particularly the oil. Oil has already crossed 90. Reserve Bank of India's assessment was estimated oil price 85. So all these things will delay the rate cutting cycle to start. So particularly among the retail buyers, how many will be able to service their loan till such time, or will they turn NPAs and from SMA1 to SMA2 and then finally becoming NPA, etc.? We need to wait and watch. Probably yes, probably yes. We will see the banks accumulating, because it's always a cycle. Banks NPAs are going up. What does it mean? Then they need to provide for, and then their profitability will be affected. So there are three things. You don't ask me, but I am telling you. One is this net interest margin, which is the technically your bank's cost of money at the which the the depositors pay, or any other form they are raising the money, and what the borrowers pay, the difference. That's called NIM, or net interest margin. Now, if the net interest margin is pretty high, then what happens is, I take care, I'm a bank, I'm taking care of my operational costs, which is my branches, my technology, wages, or fixed costs and running costs, etc. And then out of that, if I can keep my operational cost down, then it adds to my profit to that extent. So that NIM, which was, if you see the last year, the banks enjoyed pretty good NIM. Now, what is the reason? Because interest rate, their borrowing rate already gone up. Their lending rate already gone up, and the borrowing deposits not going up. Only incremental deposit rates are going up. Like if you have locked your deposit for 2 or 3 years last year, now you are not getting the benefit of higher deposit rates. I'm not getting. So only the new deposits are getting the benefit, right? So now what's happening is, as more and more deposits are getting repriced, because your 1 year or 2 year deposits now coming to an end maturity, and now you are revolving it with a higher rates. So then your cost of money goes up. So the net interest margin is shrinking. It's already started. If you see the first quarter of this current fiscal year, the banks deposit, some of the banks NIM has shrunk. Now, going forward, as I said, as more and more deposit gets repriced, etc. So you are not, since the Reserve Bank of India is not raising the rates anymore, so the banks will not be able to raise their lending rate, but their deposit rates are going up. In the process, first contributing factor to the affecting their profitability will be lower NIM in relative term. Second will be recovery will be less and less, because all the low-hanging fruits have been plucked. So you will not have as much flow of recovery as you had in the past few quarters. And third is you may have to provide for fresh bad loans, which it's almost peaked a few quarters back. You see, one of the contributing factors of bank profitability was less and less provisioning, because since they have covered most of the part, they would not need to have much. And plus the fresh slippages and the fresh NPAs were not there virtually. Now, once the new slippages start and when the bank starts accumulating new NPAs, so they need to provide for more. So more provision, less recovery, and lesser NIM. All these three things will contribute, or rather will affect the bank's profitability going forward. Does that mean it will happen in the current quarter itself, which just ended 3 days back in September? Is it story is over? I doubt. Probably September is fine, but probably by the end of this year, we'll see that we have left the golden period behind.
Right, sir. So from a quarter-on-quarter story, of course, that is there. From a larger perspective, probably the next 1 or 2 decades could be the golden period for the Indian economy. And one of the facilitating factor has been financial inclusion tools like UPI. UPI, of course, has gained worldwide acceptance now, but it's also been named a public good. So our founder Vivek Saxena is asking, does it mean that the players need to subsidize this or need to fund for UPI for a longer period of time? Because if it is a public good, then how are the players going to make money?
Yeah, it's a very valid question. I think industry is not exactly, if you ask the bankers in public sector banks will not say anything at all. The payment system, I mean, this particular thing, how can you have so much of free thing and all? But that's, I think, I am running, and that's a reality. Yeah, certain things unavoidable if you want to give it a push and want to do this. I think there will be some like for instance, if you see even the ATM usage, earlier ATM usage was just, I'm talking about many years back, was the you can go 100 times an ATM and then just pick up 100 rupees each kind of things and all. Then the each bank came out and they started restricting it that, well, in urban areas, some X number of ATM, unless you keep this kind of money, you can't have this many time, because there is a cost to it. Every time you go to an ATM, there's a cost to it. So we will not allow you more than X number. We will not allow, beyond that, we can allow you in allied banks, some more, etc. But ultimately, this is capped. So if you go overseas, every time you are using the ATM, actually there is some money has been cut. But here we don't do that at all. But there's been number of things restricted. So I would like to believe in the payment system, in that particularly the merchants, this activities where there is a concern that this should be paid for, etc. How long you will enjoy this thing? I think maybe some more time. Yeah, you can't, should it be done or it's not a good thing? I don't want to make any, because it's a politically sensitive comment. But yes, this is a reality. But having said that, if you see that we are doing so well in financial inclusion, we are doing so well in the growth of banking system. But again, the possibilities are huge, because if you see the credit to GDP ratio, where are we compared to many other countries? And that's one part. So there's a huge possibility still there, both in terms of physically reaching out to different parts of India, which is still not served. Even within urban India, there are pockets not served. And as I said, if you look at credit to GDP ratio, we are just about 150 trillion credit. So it's less than $2 trillion, 1.7, $1.8 trillion credit. And you're talking about a 5 trillion economy. And if you look at the real economic size also, it's pretty low. So there are enormous possibilities. And another relevant point is this: one of the factors which actually not so good about Indian banking is the customer service. And here, most banks, irrespective of the profile of the bank, whether it's large or small, whether it's private sector or old private or new private or public sector, whether it's tech savvy or not tech savvy, but overall, the customer care, customer is not the king in this segment, unfortunately. I think every bank needs to look at this and take action and approach it in a different way.
So how will technology play a role in this? What role do you say for the new payment banks, for fintechs?
No, I mean, it's if you look at the banks, I think it's now a time whether on the hand on heart, most banks, they want to become a tech player. That's the story. I think HDFC Bank probably officially said that we want to be a tech player.
Isn't it inevitable in a sense?
It is inevitable because of, I mean, you ask yourself, when did you go to a bank branch last time? How many years back? So technology, what happens? Technology serves two purposes. One is this, making life easy for you, for me, for everybody. I mean, and second is the cost, but the bank's operational cost driving down. So it's beneficial for the banks, and it's beneficial for the bank's customers. For us, for you and me, technology helps, because if you see the money transfer has been what we used to do and what after this UPI, what happened, the payment system. Recently, I went to a interior village in Maharashtra on the Gujarat border, and I just, as a test case, I did. Barring, I was there for 4 days, barring one particular case, some 30 rupee transaction, each and everything, whether it is charges for the Airbnb or buying breakfast or eating meals or buying some jalebis and pakoras, buying biscuits for dogs. Each and everything in this interior village I did through my mobile.
Wow.
So I did through my mobile. So this is the convenience, this is the convenience. Everything is recorded. I don't need to carry money, nothing. I was carrying little money, but it is my experiment that what do I do? I was in Danu and Bodhi, these two places, which is close to Bapi of Gujarat. These two on the sea beach. I was there 2 days each, and I did not pay. I just only on one single occasion I used 20 and 1 10 rupee notes. The rest of it was that's what technology is doing. So it is for customers making life easy, and it's for banks also cutting down their cost, and which is why getting into financial inclusion is far easier now, because technology can change. Only thing is this: the problem is this, like the fraud part of it. The fraud part of it. So which you will find that every day some of us have become a victim of fraud. And that's a continuous learning, continuous teaching that needs to the financial sector, the government, the RBI needs to do. The bankers are teaching us that don't do that, etc. So that's the one side effect, if I may say. So it's that the cyber security and cyber fraud. Now, as we become more and more aware, I think, as I said, probably in the next 1 decade, you will find that banking is actually, bankers are being, they're all tech platforms, they're all technology companies, not banks anymore, and that's the global trend.
Right, sir. So in this scenario, we are talking about banks being on a roll, or are they actually on a roller coaster?
Yeah, as I said, that for the past 2 years is pretty good, particularly if you see from the first quarter of 2023 fiscal year, every quarter is better than the previous quarter. And of course, there are naysayers, there are Cassandras. I have been also flying out that how long it will continue. When the tide goes off, we'll see who are swimming naked. All these things, we are using it, but you see the bankers are happy, and every quarter is better and better. If you look at most banks, NPAs are decadal low, and their profitability is highest ever. Look, State Bank of India, the kind of profits it's been making, despite all talk about naysayers and all, but you see the profitability kind of things and all. So I think this will continue for a few more quarters. I'm just repeating myself. Probably this current financial year, which is ending March 2024, the banks will continue to do a good job. But it will, as I said, the cycle will, like every time there's a cycle. But the three things, as I said, the recovery, less recovery, higher provisioning, because NPAs will be going up, even though it will not be very sharp rise, but there it will rise. And third is the recovery is already, much of the recovery is already done. So all these three contributing factors, and other part is not exactly directly affecting the balance sheet, but it is affecting the question of talent. We must discuss that. The HR, if you see that HR managers in every bank, they are going through a horrible time. They are going through a horrible time. People are leaving. If you see the people leaving, that every year it's in percentage term, 20%, 25%, 30%, 40% kind of thing people are leaving. Because what happened is this: post Lehman, 2008, the Lehman crisis, the entire financial sector, HR, turned into a different zone. It was pretty easy. People are losing job, etc. So yes, you have come here, be happy with whatever you get, and that was the kind of situation. But now COVID, and this, I think COVID also played a critical role in propping up the technology. And you see the young persons, so the young bankers are much more ambitious. there, if you want to give them only money and give them a handsome raise, and you think they will be able to retain, you will be able to retain them. No, it's not. Even if I don't have any job, I'll just quit if I don't like, and I'll start a startup. You see how many people in their 20s and 30s, they're doing this. So this is a nightmare for the banking system. You can't retain people by giving money. You have to really give them the challenge. I need to be happy with what I'm doing. Every day I need to come to office. Earlier it was there, office out, chai pio, kam karo, and then maybe late evening or early evening go back. But now, no, this generation is very different. Their ambition is very different from the other generation. So apart from all the technical things which are affecting their balance, which may affect their balance sheet, other big nightmare and the big challenge for the entire banking system, particularly the private banks, is the people, turnaround of people leaving, and the question of talent. So all these things put together, I think we call it roller coaster, it's a melting pot, don't know, but things are very different, and all the leaders, they have a very, very tough job in hand. I'm talking about the banking leaders. Because if you see the three distinguishing factors between banks and other entities are this. A, you are dealing with public money. No other entities do that. Your money, my money, your banker's own brother's money and son's money and father's money. So it's a public money, which is why when Reserve Bank of India asks for new licenses, they only go by a particular amount which you need to bring in, and whether you are fit and proper, quote unquote. Not that you can bring 10 times that amount and can get a banking license. No, you have to be fit and proper. So it's a money business. And second contributing factor, second differential factor is this. This is one of the rare business where you see both the raw material and finished product is the same. Look at any other thing, whether it's cement or soap or chemical or this thing, you get so many other things. So you get sand, you get this, you get that, and then you make cement, kind of, or for that matter, medicine or soap or chemical. But here, money, you get the money you lend. I mean, both the raw material and the finished product is the same. You just how you package it. So that's it. And third is, other part is it is no other profession. A company is known by the leader's name. I mean, you really don't care much about a chemical company or a cement factory, who is the boss, etc. But bank is defined by your leader. I mean, globally also you will find that. Jamie Dimon, that's it. It's Aditya Puri, that's it. It's Uday Kotak, that's it. Unfortunately, public sector banks, they have a smaller tenure, but in the private sector, it's a personality defines the animal, which is bank is. So if you ask me, we are in the cusp of change, a very seminal change in terms of technology. So and there's a lot of other contributing factors. So over the next 2 years, fiscal 2024 and 25, I think it's you call it a roller coaster or you call it a melting pot, whatever it is, but very exciting and challenging time for banks.
So thank you so much for your wisdom, sir, for sharing your wisdom. And that brings us to the last question, which is from a young participant, Jignesh Mistry. He's asking, what advice do you have for young professionals aspiring to build a career in financial journalism?
Well, it's very difficult to say. I think in a sense, there is I can just say some usual stuff that when financial journalism is little different from other journalism, because based on what we write, people make money or lose money. Whether we are analyzing an entity's performance, be it corporate or banks, or it is a listed entity, or talking about economy and other things and all. Like if there is no offense intended for general journalism, but what happens is in the political writings, the impact is different, or you writing on cinema, the impact is different, or you are covering a flood or drought or a train accident. You may go wrong by number of deaths, etc. You may go wrong the reason, etc. But that does not affect the reader's purse. But in business journalism, what we write, based on that, people may make money or lose money. So I think the governance, ethics, it's very, very critically important. Apart from knowledge, what we're writing and what does it mean, the interpretation, which is the key thing for every kind of journalism. But what business journalism is, and ethics and governance also, it's true of any form of journalism, but particularly business journalism, I think one needs to be. But that's a general comment. But and of course, as I said, you need to understand things and you need to ask questions. Let's not have the approach that I know it because I have read it somewhere, etc. I think you need to, and again, it's a more psychology play, how one cultivate sources and get news, so on and so forth, and ability to interpret things also. But one line I say everywhere: whatever we do, if we see it as a profession without love, then it's very difficult to do well. So I personally believe in that whatever we do, we must love it. It just, it has to be a passion. It just, if you are doing it for salary and at the end, and anyway, journalists are not that well paid, even now, after the corporatization of most of the media houses, they're not well paid. They're not compared with the corporate salary. So, but if we do some job for only for, we'll be known for by others, people will call me, etc. And at the end of the day, money. I think that's not the case. It just one needs to love one wants to, and that's true for every profession. I think the moment we love what we do, we are passionate about what we do, then we are bound to excel. And then money is a byproduct; it will come. Fame is a byproduct; it will come. But the best part is, or the main thing is this: let's love it. Let's be passionate about it, and that's it. Then everything will fall in place.
Thank you so much, sir. There's so much of wisdom in this last 1 hour that you've shared with us and thrown a completely different light on what's happening in the banking sector. So thank you once again for your time, sir. It's a pleasure having you with us.